So, imagine you are just sitting at your desk, all right? You pull up the Q1 earnings report for a company in your portfolio, and the headline numbers are just spectacular.
The exact kind of numbers you want to see.
Right. I mean, they just absolutely demolished Wall Street's expectations, beating revenue estimates by like nearly $4.6 million. You
Hmm.
might mentally start popping champagne.
Naturally.
Yeah.
Yeah, that's a huge beat.
Yeah, but then you refresh your screen, look at the actual stock ticker, and realize you have somehow lost 28% of the company's value in a single afternoon. Welcome to the ultimate Wall Street paradox.
It is, well, it's a brutal scenario, honestly,
Yeah,
because, when a consensus estimate points in one direction and a company beats it that soundly, the natural assumption is an instant market rally.
exactly.
But seeing a stock just fall off a cliff after a massive earnings beat, that goes against basically every instinct we have about how financial markets are supposed to behave.
And we are digging into this exact scenario today. This deep dive is completely focused on the Q1 2026 earnings report for Limbach Holdings, which was released on May 5th and 6th of 2026.
Yeah, and the core mystery here is just staggering.
It really is. Limbach released their numbers, and on paper, like we said, they were phenomenal. Earnings per share came in at 64 cents. That beat the 21-cent consensus by a massive 43 cents.
Wow.
Yeah, and revenue hit over $138.8 million.
I mean, those are the kinds of top-line beats that executives literally dream about.
Right. But the reality was a total nightmare. On the exact same day they reported those numbers, the stock price took a massive nosedive, dropping all the way down to $81.77.
Which, for anyone just skimming the headlines of their portfolio, makes absolutely 0 sense.
Yeah.
A revenue beat, a massive earnings beat, and then the market responds by wiping out over a quarter of the company's value in a single trading session.
Yeah.
It's wild.
It is wild. So we are pulling out the magnifying glass for you today to figure out why. We are taking their earnings press release, the Q1 call transcript, and the SEC 10Q filing to, really piece together the real story here.
Yeah, there's a lot to uncover.
Definitely. We're going to explore the intense margin pressures weighing the company down, take a hard look at their recent fixer-upper acquisition of Pioneer Power, and ultimately reveal the massive data center boom that could be their saving grace. Okay, let's unpack this.
All right, so to understand why Wall Street punished Limbach so severely, we really have to look past that top-line revenue number. We have to dig into the underlying profitability metrics.
Right, because revenue isn't everything.
Exactly.
Yeah.
The market is incredibly ruthless right now when it comes to the actual quality of a company's earnings, rather than just, the raw amount of money changing hands.
And the quality of these earnings definitely had some serious blemishes. Total revenue was up, sure, but the consolidated gross margin fell significantly. They dropped to 22.4%, which is down from 27.6% a year ago.
And that's a big drop. The cascading effects of that margin compression were severe across the board. I mean, net income dropped a staggering 57%, down to $4.4 million.
Ouch.
Yeah, and furthermore, their adjusted EBITDA, which strips out things like taxes, depreciation, and amortization to give a much clearer picture of raw operating cash flow, that declined 41.7% down to $8.7 million.
So the revenue is up, but the actual cash they are keeping in their pockets is shrinking fast.
Exactly.
And management, they blamed a few operational hurdles for this on the earnings call. They noted that while total revenue grew, their organic revenue actually decreased by 13.4%. And by organic, I mean the revenue generated by their existing foundational business, excluding recent acquisitions.
Right, and they also faced a barrage of higher fixed costs. They expanded their vehicle fleet, faced higher insurance premiums across the board, and spent more heavily on tools and safety protocols.
Just a lot of expenses hitting at once.
Yeah, and add to that a seasonal dip among their industrial customers, which, well, management claims is fairly typical for the first quarter.
But it all adds up.
It does. If we connect this to the bigger picture, this is a textbook example of the damage caused when fixed cost absorption breaks down.
Break that down for us.
So, in a mechanical contracting business, you have structural expenses that simply do not care how many jobs you book this month.
Right.
The leases on those service vans, they must be paid.
Right.
The insurance premiums come due. The salaries for your specialized engineering personnel remain completely constant. When your core organic revenue dips, you simply have fewer incoming dollars available to cover that immovable block of fixed costs.
Makes sense.
So every single dollar of revenue suddenly has to carry a much heavier burden, and that weight eats directly into your profit margin.
I see it like a star basketball player who scores 40 points in a crucial game.
Okay, I like this.
Right. On paper, you look at the box score and think they deserve the MVP trophy. That 40-point game is the revenue beat. But then you watch the game tape and you realize they turned the ball over 15 times and played absolutely zero defense.
Yeah. Terrible efficiency.
Exactly. The actual efficiency of the margin is destroying the team's chances of winning a championship. Wall Street isn't just looking at the points scored anymore, they are heavily penalizing the turnovers.
Like a perfect way to look at it.
So my question is this margin drop a permanent new reality for Limbach, or are we looking at like a temporary solvable hiccup?
Well, answering that requires us to isolate the specific culprit, dragging down those profitability averages, and the glowing red dot on their financial radar right now is their recent acquisition, Pioneer Power.
Ah, yes, Pioneer Power. Limbach bought them back in July of 2025, right?
That's right.
They paid $66.1 million for the company, primarily to expand their geographic footprint into the upper Midwest, kind of establishing a stronghold in the Twin Cities region.
And geographically, it's a smart play. The Midwest has a dense concentration of the exact industrial and institutional clients Limbach targets.
But financially,
Financially, however, this deal is acting as a massive double-edged sword in the first quarter of 2026.
because Pioneer Power contributed $23.5 million to the Q1 revenue, that is a massive chunk of change.
It's huge.
And it's the primary reason Limbach beat those top-line estimates so handily. But the catch is that Pioneer is currently operating at a severely lower margin than the rest of Limbach's legacy business.
Yeah, it's heavily dilutive. If you exclude Pioneer Power entirely from the math, Limbach's overall gross margin would have been a much healthier 25%, not the 22.4% they actually reported.
Wow, so it really dragged them down.
It perfectly illustrates the hidden peril of corporate acquisitions. I mean, buying revenue is the easiest thing a management team can do.
Right, if you have the cash.
Exactly. If you have enough cash or access to a large revolving credit facility, you can simply go out and purchase a company that generates sales. But the true test of executive leadership is integrating that company, overhauling its culture, and raising its profit margins to match your historical averages.
It's the ultimate fixer-upper real estate scenario.
Yeah, how so?
You buy a giant rundown house in a great neighborhood, you get the extra square footage immediately, that's your instant revenue bump. You can invite everyone over to see the massive new property.
But the pipes are leaking.
Exactly. You are fully aware the plumbing needs to be replaced, the roof leaks during heavy rain, and the kitchen hasn't been updated since 1978. It takes years of expensive, tedious renovations before that house actually increases your total net worth.
And to their credit, management was remarkably transparent about this reality on the call. They outlined a comprehensive 2 to 3 year turnaround plan, specifically designed to get Pioneer's margins up to the company average.
Okay, but if I'm renovating a house, I'm tearing out drywall and replacing copper pipes. For a mechanical construction firm like Limbach, I have to assume renovating Pioneer means aggressively hiking up prices on their legacy contracts and firing unprofitable clients. Is that the strategy here?
That is exactly the playbook.
Yeah.
They are systematically reviewing Pioneer's existing book of business and, renegotiating for significantly better pricing.
Getting rid of the dead weight.
Exactly. They are optimizing the project mix, actively turning down lower margin bids that Pioneer might have accepted in the past just to keep their crews busy.
Right.
Furthermore, they are heavily relying on a cross-selling strategy. Limbach plans to take its specialized high-margin services, particularly its data center expertise, and sell them directly to Pioneer's existing customer base in the Midwest.
So if fixing Pioneer is a multi-year heavy-lifting renovation project, what does the foundation of Limbach's core business actually look like while they do this? I mean, are they sacrificing their main engine to fix up the new acquisition?
That's the big question. We have to look at the fundamental architecture of their business model to judge the health of that main engine. Over the last 5 years, Limbach has undergone a radical transition regarding who they actually sell their services to.
Right. They divide their business into two main segments now. General contractor relationships, which they call GCR, and owner-direct relationships, or ODR.
Let's start with GCR. The GCR model is the traditional old-school way of doing construction. In a GCR setup, Limbach operates basically as a subcontractor.
Like a massive general contractor wins a billion-dollar bid to build a new hospital wing, and then they hire Limbach to come in and handle the heating, ventilation, and plumbing systems.
Precisely. But in that environment, The general contractor holds all the leverage. They dictate the project schedule, they tightly control the flow of money, and because there are multiple layers of contractors involved, everyone takes a slice of the pie.
Which naturally suppresses Limbach's profit margins.
Exactly. Additionally, you're constantly bidding against every other mechanical contractor in the region, creating this constant race to the bottom on pricing.
So, what does this all mean? Being stuck in the GCR model is basically like being a freelance graphic designer who only gets work through 3 different layers of temp
Oh,
agencies.
that's a great comparison.
Yeah, you do all the actual heavy lifting and creative work, but the agencies take 40% of the fee and you never even get to meet the final client. You have no relationship to leverage for future work.
And ODR owner-direct relationships is the complete opposite.
This is where Limbach bypasses the general contractor entirely, right? They work directly with the facility owner, whether that's a hospital network, a university system, or a massive manufacturing plant.
Yep, and bypassing that middleman changes the entire economic dynamic. In the ODR model, you are negotiating directly with the decision maker.
Which translates to higher margins.
Higher margins, deeper trust, and vastly better long-term stability. You stop being a hired gun brought in for a single construction phase, and you evolve into a vital maintenance partner for the entire lifespan of that facility.
And the numbers clearly show management is obsessed with this transition. ODR made up 71.9% of their total revenue this quarter.
That's a huge shift.
It is. They stated their ultimate target is a stabilized mix of 75 to 80% ODR going forward. They are intentionally starving the general contractor side of the business to feed the direct owner side.
Which is smart, but there's a catch. Even though total ODR revenue grew by 10.4%, which was largely driven by incorporating Pioneer Power into the mix, their organic ODR revenue actually declined by 5.4% this quarter.
Wait, really? The core organic ODR dropped.
Yeah, but management stressed that this was a planned, fully expected dip based on the timing of project bookings from mid-2025. They were not caught off guard by this at all.
Okay, so it was a timing issue because they seem entirely focused on establishing themselves as an indispensable building systems solutions partner. That is the phrase they kept hammering on the call.
They did, and they accomplished that status through what they term evolved customer solutions.
Right.
Instead of simply showing up to fix a broken industrial air conditioner, they bundle highly complex services. They offer integrated facility planning, massive energy efficiency overhauls, and complete MEP upgrades.
And MEP, that's the mechanical, electrical, and plumbing infrastructure, right? The literal guts of a building.
Exactly. When you provide that level of complex, bundled service directly to an owner, you create incredibly sticky relationships. I mean, think about it. A hospital network is not going to casually fire the contractor actively managing their multi-year, multi-million-dollar decarbonization strategy.
That makes total sense. But if organic ODR revenue is currently in a planned dip, and Pioneer Power is a messy multi-year renovation project draining their margins, how on earth is management confidently projecting $730 to $760 million in revenue for the full year of 2026?
It sounds like a stretch, right?
Yeah. What is filling that massive gap to keep them on track?
Well, Wall Street was entirely focused on the trailing margin compression, but management is looking at a tidal wave of new business coming down the pipeline. The answer to their confidence lies in an absolute explosion of future bookings.
And the numbers here are staggering. In Q1 alone, they secured $209 million in new bookings. That results in a phenomenal book-to-bill ratio of 1.5x.
Yeah, and for context, a book-to-bill ratio is a crucial metric in the contracting world. It compares the amount of new orders received the bookings to the amount of revenue actually billed during that same period.
Right, so a ratio of 1.0 means you're bringing in exactly as much work as you are completing.
Exactly. So a ratio of 1.5x means for every dollar of work Limbach finished and billed in Q1, they added $1.50 of brand new work to their backlog.
So they are filling the bucket significantly faster than they are emptying it. Over the last 2 quarters combined, they have booked over $434 million. And the star player driving this massive influx of cash is undeniably the data center sector.
Right, absolutely.
A full 27% of all Q1 bookings came directly from data center opportunities.
This is the secular tailwind dominating the industrial landscape right now. As artificial intelligence models become more complex and cloud computing continues to expand, the physical infrastructure required to support them must scale up dramatically.
Because data centers are incredibly hot, right?
They are essentially giant, power-hungry ovens. Keeping those servers from literally melting down requires incredibly complex, robust, and massive cooling and mechanical systems.
Yeah, and management actually detailed a specific new win on the call. They mentioned a $30+ million fabrication project for a brand name hyperscaler.
That's a huge win.
It is. They are providing a completely fabricated package of steel structures and piping systems, and they expect to generate that revenue rapidly over the next few quarters. They also highlighted a $6 million retrofit project, won specifically through Pioneer Power.
Which proves their strategy of cross-selling data center expertise into the Midwest is actually functioning in the real world.
Right. The speed at which they can deliver these projects is critical, too.
Oh, absolutely. Hyperscalers, the massive cloud providers like Amazon, Google, and Microsoft, are locked in an absolute arms race right now. They do not have time to wait for traditional multi-year construction timelines. They need cooling solutions built, delivered, and operational yesterday.
Okay, here's where it gets really interesting because I need to push back on this narrative a little bit.
Okay, let's hear it.
Right now, every fast food chain and shoe company on the face of the earth is sprinkling the words AI and data center into their earnings calls to sound innovative and boost their stock price.
That is very true.
So sure, everyone claims to have these relationships with tech giants, but do they actually have the physical industrial capacity to build this stuff? Or is this just PowerPoint vaporware designed to distract investors from their sinking margins?
What's fascinating here is that Limbach is not just slap an AI sticker on their marketing brochure and hoping for the best. They have real battle-tested credibility in this space.
Really?
Yeah, management was very quick to point out that they have 10-plus year relationships with these hyperscalers. They were designing and building these complex cooling systems long before AI became the hottest buzzword on Wall Street.
All right, a 10-year relationship is great, but a relationship doesn't weld steel piping together. Do they have the actual footprint to meet this explosive demand?
They do, and it is the ultimate trump card they're playing against their competitors. They have the physical infrastructure to back up their claims. Specifically, they cited a massive 14-acre fabrication facility they acquired back in 2021 when they bought a company called Jake Marshall.
Wow, 14 acres of dedicated industrial space just for fabricating massive piping and steel structure.
Yeah, and that 2021 acquisition gave Limbach significant excess capacity. To understand why this matters, you really have to look at how prefabrication works.
How does that usually go?
Well, traditionally, you bring all your raw materials to the construction site and build a cooling system there. You're contending with bad weather, limited space, and other contractors getting in your way.
Sounds like a logistical nightmare.
It is, but off-site fabrication changes the game entirely. Limbach can build these giant, complex piping modules in a controlled warehouse environment, while the hyperscaler is still bulldozing dirt and pouring the concrete foundation for the data center.
Oh, wow, so it runs concurrently.
Exactly. When the building is ready, Limbach simply trucks the finished module to the site and bolts it in. It shaves months off the construction schedule. That specific speed-to-market capability is exactly what these tech giants are desperate for.
I mean, that is a phenomenal competitive mode. You cannot just spin up a 14-acre industrial fabrication facility overnight to chase a trend.
No, it takes years of zoning, planning, permitting, and equipping. Limbach has it fully operational and ready to go right now.
Which raises an important question about how we interpret their long-term trajectory. Yes, the Q1 margins took a severe hit and Wall Street punished them for it. But when you factor in their ability to execute high-margin, rapid turnaround data center work at the scale, the narrative shifts significantly from a company in distress to a company in transition.
That's a great way to put it.
Let's summarize this journey for everyone listening. Limbach's Q1 2026 report is an absolute masterclass in why you must read past the headline numbers. On paper, they delivered a revenue and earnings beat.
Yep.
But in reality, that top-line success masked severe margin compressions and very real integration growing pains from their $66 million Pioneer Power acquisition.
But zooming out reveals a much stronger foundation. Their strategic, disciplined shift toward owner-direct relationships, combined with a staggering $209 million wave of new bookings, heavily fueled by the data center boom. It tells a different story.
It really does.
It suggests that the stock's 28% drop might have been a harsh, short-term overreaction to a necessary long-term transition.
Absolutely. And whether you are an investor analyzing market overreactions, a business strategist studying acquisition integration, or just someone fascinated by the hidden infrastructure of the modern world, this case study proves two crucial points. First, in the modern stock market, raw growth without strict margin discipline will get you severely penalized. The market demands efficiency, not just scale.
And second, it proves that owning the physical picks and shovels of a technological revolution is an incredibly powerful position. Everyone focuses on the software algorithms of the AI boom, but absolutely none of that software functions without the physical HVAC and piping systems keeping those server farms from melting down.
So true.
Limbach is positioning itself as the essential safety net for the digital age.
Which brings us back to the CEO's comments about their 14-acre fabrication facility. He explicitly stated they are winning these rapid data center jobs right now precisely because they have excess capacity at that location.
Right, that's a huge advantage.
That facility is their secret weapon against competitors who are scrambling for space. But I want to leave you with a final thought to mull over. If the AI and data center boom continues accelerating at this breakneck pace, how long until that 14-acre facility is completely maxed out?
That's the real question.
Exactly. When that excess capacity vanishes, will Limbach be forced into another expensive, potentially margin-diluting acquisition just to keep up with the demand? Or will they have to start turning away highly profitable work because they simply run out of room to build it? Surviving the fixer-upper phase is hard, but managing hypergrowth well, that might be their ultimate test.